Hello YouTube, I'm here with Alex Roepers in Luxembourg. We just had an interview on his process, how he's analyzing companies, how he's buying and selling stocks. So if you like it, subscribe to our channel. Thank you. Hi Alex, welcome back to our YouTube interview. In this second part, I want to look with you into the process and ask some questions about the steps when you're analyzing companies. So, how do you get your investment ideas?
Well, when we started the firm 31 years ago, I came out of two companies I worked for before, Dover Corporation and Thyssen-Bornemisza Group. These are industrial conglomerates, and I learned a few things about valuing companies, learned to dislike illiquidity, and I wanted to be invested in the public market, in mid-sized company, which was the focus of my previous employers. Stay away from high tech, because of technological obsolescence risk being a very hard to analyze factor, and stay away from lack of transparency factors, which are mostly companies in the financial, banking, insurance area. So we stay away from those companies per definition. So we start with a universe definition that says, okay, we want to be not in illiquid companies because we want to be in the public market. So why be illiquid in the public market? So below $1 billion, we don't look. We also want to engage with the company for due diligence purposes and for constructive engagement purposes at the highest level. So we stay companies where we can reach that level. Typically $10–15 billion is the high side of the market cap we're looking at. And we're also looking for companies, there's another reason for that size range, for companies that can unlock the value through corporate action, which is what the company can do itself, and we will push for ideas to help them, with M&A, share buybacks, improving just the mix of the business, and activism, behind the scenes and then overt, and then corporate takeover. The takeovers of $5–6 billion companies is the sweet spot for private equity firms. If you imagine a $20 billion firm fund, they would deploy maybe in 10 deals, $1 or $2 billion per large deal, and then you put some leverage on it, so you get to a $6–7 billion, $8 billion deal. Those are the kind of deals that private equity sees as perfect targets size-wise. So are corporations. If you see mergers at the much higher level, above 20 billion and north, you can't finance them with debt. You will not do, most likely, a takeover with a big premium. You do a merger of equals or a merger with stock, and it will be a much less attractive premium when it happens. So we look for a variety of reasons in this mid-cap space. We think we can be differentiating ourselves to our clients. We can differentiate our research and come up with ideas that are not well understood, and concentrate on the high conviction ideas in this area. So universe definition is step one. Step two, so once you're in this $1 to $20 billion range, you exclude high tech and banks and some other areas that we exclude, like product liability risk, like for instance tobacco we would not invest in, or some other areas. Also government interference risk is an area that we exclude because we can't have people running on Capitol Hill figuring out what's going on with Medicare and Obamacare, etc. So we avoid those areas. Once we have this universe, and in the US it's about, I would say, 1,500 companies, and we then deploy some other qualitative and quantitative criteria. Number one, we look for companies that are more predictable, reliable in cash flow generation, and that have always been profitable. So what you knock out immediately are shipbuilders, iron ore, steel companies, etc. Pure cyclicals are out. We much prefer an elevator company, for instance, with a lot of maintenance, repair, and overhaul from the installed base, than say furniture maker, which just sells furniture in a good upcycle and has a huge decline when people retrench and don't expand their offices. So we look for MRO, maintenance, repair, and overhaul, consumability as a large factor of sales and earnings to give more predictability and stability to the company. Always been profitable, so no pure chemical and commodity type plays. And then we look for reasonable balance sheets. It doesn't have to be investment grade, but we want interest expense to be at least 4 times covered by EBITDA. And that EBITDA, which gross cash flow, it better needs to be predictable and reliable to a large extent. And then we like multiple catalysts. So we prefer to focus on companies with low insider ownership. What that means, if it's controlled by a family and it's undervalued, it might stay undervalued for a very long time, and a takeover is not possible. So while we have invested in the past in some cases where there is a controlling factor, those are quite special, and they're quite often less than 10% of what we do. The majority are companies where the insiders might have a large part of their net worth tied up in the stock of the company, so we like the skin in the game part of it, but collectively, the board and management owning less than 10% means that they're vulnerable to outside interference should they not perform well. And so those are some of the criteria. Once we have that universe established, we become value investors. So now we look for oversold companies that are trading at, say, 10% free cash flow yield on earnings that are lower than they should have been. Clearly, they're lower than they should have been because the share prices are way down from a recent high on disappointment in earnings and some other setbacks that are either self-inflicted or more macro or or industry-specific that has hurt them. So we look for that, and we're literally like a bunch of snipers lying in wait on a limited universe. We have pretty proprietary and sophisticated models and signal systems watching our universe in the US, Europe, Japan, and China. And we know our targets, we know our herd, if you will. We watch that herd very carefully, and we're literally waiting for companies to fall in our lap that have some issues, and you can see it in the share price decline, you can see it in the valuation. And as a team, with the analysts that we have at Atlantic, we look all over these names, bring them into the top 30. That means they can get visited, that cash flow models are rebuilt or built for the first time, and that we start traveling to the company and meeting with management. So that's kind of the process. Once we have the top 30, say in the US or Europe, out of that come names that are becoming more and more interesting. They end up becoming an investment. Once we scale into an investment, obviously we step up the due diligence further, meetings with management, and then it's really a factor of or a function in terms of the percent of capital that we allocate between the predictability, the reliability of earnings and cash flow. The lower the valuation, the more catalysts we see, including ones we could possibly trigger ourselves as a minority shareholder through proactive suggestions, letter writing, etc., the more we like it. So that's really the concentration of capital and the highest conviction ideas is what makes up our portfolio. So hopefully that gives you an idea of our roadmap.
Do you have some numbers, like how big is your universe and how big is your watch list you're covering companies
If I'm
closer?
correct, there's about 18,000 companies publicly traded or so globally, above 100 million in market cap. So you start there. If you look at companies in the mid-size range, between 1 and 20 billion, I think it is about 6,000 or so companies. Is that correct, guys? And then I would say there's about, in the end, if you screen it down, we have about 500 companies in our universe in the US, 250 in Japan, about 300 in Europe that are of main interest to us. In each of these three major areas, I'll talk about China separately if you want, we have this top 30 and we have about 10 or 15 investments. So about 45 companies in the US are of great interest at the moment. Of course, it changes over time, but there's 10 investments, the top 5 or 6 are our core holdings where we roll up our sleeves and we get really under the hood, under the skin of management, write letters, etc. Our global fund is about 18 stocks. 6 are the top US names, typically represent 40% of capital. Then we have the top 5 or 6 European names. Collectively, they're about 30-35% of capital. And we typically have 15 to 20% in Asia, where we have a selection of Japanese and Chinese stocks that make up about 20%.
How long does it take for you to invest in an idea after you discovered it?
Well, having done this for 31 years and having a defined universe and a very, intensively traveling and analyzing team that we have, I would say we get up to speed pretty quickly. But if it's an entirely new name, visits are obviously required to have been done. Analysis that we call 360 analysis, talking to suppliers, customers, other shareholders, sell-side research. I mean, anybody who can have a view on the company from different angles is performed. And then, it might take, not a couple of weeks, but I would say 1 or 2 months for an entirely new name. I would say 80 or 90% of what we do these days is repeat investing. We go back into the same companies, sometimes a year later, sometimes 10 years later. They just come back into our fold with valuation and attractive risk reward that causes us to step up our due diligence again, refresh it, and quite often it's like, hello, we're back to management and pick up where we left off and said, so how come you guys are trading at this level? What's been going on the last few years? Of course, we know that, but we want to hear from them. And then we try to get out of that hour meeting and out of the additional due diligence, the conviction for us to build up a position. But then it's really important, what size do you make it? Stock picking is only half the game. The other game is, sizing. And the sizing is absolutely critical. And then the dynamic sizing is very critical for total return over time. So if you just allocate to 100 stocks, in the value space, you might underperform or overperform the index by certain percentages. But at the end of the day, high conviction investing and then trading the position as it, for instance, moves up to trim it enough to keep it in check at the percentage that you felt comfortable allocating to it, given the characteristics of the investment, the predictability, the valuation, the catalyst. So the moment it starts moving up, you start taking money off the table to keep it in check. But then, of course, if a stock moves up, say from 30 to 39 in, say, 3 months, the risk reward is not as attractive as it was at 30. So you bring the percent of capital down on top of the trimming you've been doing. So it might be that if a stock is a core position at 30 with a $50 target in 12 to 18 months, by the time it gets to 39, we've sold half the position. But then we've captured maybe in 3 months an IRR of 120% on whatever we sold. And guess what? Stocks don't move in a straight line, they fluctuate. And so when they come down, we put the hammer down again and start reloading the position with some of the funds that we have from selling the stock earlier on strength. So we do a lot of dynamic sizing. The dynamic sizing has added about 20% of our gross returns over the last 30 years. It's a very substantial number. If you look at the way we've performed, I would say the market obviously is part of it. The market is up 8 or 9% over those years. And we've done more like 16% gross. And a good chunk of that, so about 20%, is dynamic sizing. The rest is stock picking. So very important for the viewers here to understand that it's one thing to pick a really good stock. The other question is, do you make it 1% or 10% of your capital? And once you make it 10%, what do you do with it? You cannot just act differently. If you make it 1%, you can afford to sit around, let it flop around. But if it's 10% of your capital, the moment it starts moving up, you got to be alert and take percentages off and not let it grow into be 20% of your fund. It's a great winner then, but do take money off the table and do evaluate the risk reward of what that position is after it moves up 40 or 50%. Congratulations, you have a big win, you concentrated on it, but do something about it. Unless you'll just let it go. But that is a risky long-term strategy in our view.
So you aren't a buy and hold investor?
No, we're not.
Okay. What role does history and culture play in your research process? On the one side, how long do you research a company in the past, and how do you make sure that you find the right culture in the company you're investing in?
How long do we research a company in the past?
Yeah.
It's, in some cases, many, many years, right? And but for a completely new position, as I said, it's brand new, which is rare. In 1 or 2 months, we can, if need be, we can get up to speed. It's rare we find something new that we then invest in within 1 or 2 months. Typically, we do the due diligence, and we still wait until it's even cheaper at that moment. As far as finding the right culture in a company, that's not really what we're looking for. We're looking for very solid companies. Quite often they're managed by folks who have very good intentions, who are very nice people, but clearly they're not A+ players in many cases. If they were A+, they would be trading in valuations we couldn't touch them at because of our value discipline. So most of these are solid, good people. Hopefully they have a good culture there. If they don't have a good culture, that will be reflected in the stock, and we'll try to figure it out. And sometimes a replacement of the management is needed. That's rare though. In most cases, we work with the managements that are there and trying to help them with constructive ideas to push an agenda that works for everybody.
Interesting. So you look for companies that could be run by apes, to put it more in a...
No, I wouldn't go that far. But I would say these are companies that are well established, that typically have a deep bench of managers at the regional or up at the divisional level. The CEO is in charge, obviously, at that moment, but you could make a case that in many of those companies you could have a replacement, and it doesn't really change the dynamics of the company. It's not like the famous CEOs, the star CEOs that you see in some of the high growth companies that are very dependent on those individuals. I think the companies we have are largely, well-run, larger companies where there are corporate executives that have their career, but they come and go and they have succeeded. And so it's really, our task to hopefully find that there's a good one running it, that there's changes made as necessary. But I wouldn't say that the apes can run these companies, obviously, but that's only a figure of speech on your part.
How do you make sure that the companies have a good moat? That the moat is strong and they have competitive advantages against other companies?
Oh, moat, yeah. No, of course. If you look at almost each of our companies, they've survived ups and downs over many, many years, economic setbacks. and they're well-established companies. So that's one of the reasons we go into already very well-established companies that have this moat. So if you look at an Owens Illinois, for instance, the fact that you have 77 factories around the world, in Brazil, in Colombia, Mexico, Australia, all over the US, it's a huge, the manufacturing footprint of this company, the customer relations, the cost of replacement of that manufacturing footprint is a huge moat for that company. If you take a Timken, what we mentioned earlier, again, it's the know-how, the manufacturing capability, the customer relationship, the trust that the customer have in the quality of that product, which is a critical product in the functioning of their equipment. They're not going to just swap that out to somebody comes up with a nice ball bearing. This is a long process of approval and application. Same for companies that are involved in the aircraft industry who make landing gear. You cannot just go back and get spare parts for that landing gear from somebody else. You have to go back to the manufacturer because that's what the rules are for the FAA. And so we look for maintenance, repair, overhaul, consumability, and other ways to get the moat around the company, defensibility of the business that they have.
Can you tell a bit more about your style of activism and active investing?
Yeah. So our constructive shareholder activism, CSA as we call it in short, is engaging with the company, with the management proactively as part of our due diligence. It starts with due diligence, but towards the end of the conversations, we will ask them, what they think of A, B, C, D, and E in terms of ideas to improve the value of the company. We get a response. They've tried obviously certain things and either didn't pursue them or they didn't work well, etc. We get a pretty good idea what they've worked and what hasn't worked. We will give them verbally our concept of what we think they should do urgently at this moment, whether it's different use of cash deployment, prioritization of balance sheet repair, discipline on acquisitions, messaging, corporate governance issues, etc. So there's a whole range of things customized for the company. We get the response verbally on that, but then at the end of this major meeting, we would say thank you. We'll send you a letter as a thank you letter, including our concept of what they should discuss at the board for the way forward on a bunch of areas. So we write quite a few letters, as you can imagine. These letters are the beginning of a paper trail that then frames the conversation going forward, and it stays always in a way where it's, dear executive, don't do what's in our letter, do something that's better. Maybe you know about an acquisition proposal or acquisition candidate that we cannot possibly know about. If that's better in terms of growth and accretion to earnings than what we're suggesting, please do so and don't do a letter. But if you don't have that, then we suggest you start pursuing some of the actions that we've recommended. And so it's a very pro-management, let management take the action, let management get the credit for the actions that are taking. All we want is a higher share price and to get out, over time of that share price. And we tell them that, we're not like buy and hold, as I mentioned to you earlier. We're there to make money for our clients. We're trying to make the executive get the credit for what they're trying to do and achieve a higher share price. And our idea of their success is us having a handshake and a lunch saying, that was great, goodbye, we're not a shareholder anymore. One day, hopefully never in the future, when the wheels come off, we will be back as a shareholder, we'll talk again. But at this moment, we would say goodbye. So we are liquid activists, that's key. We're not taking actions that make us illiquid, typically. We always want to reserve the right to do so in a unique case. And in most cases, we will stay liquid. So there are hard and soft activism on the spectrum. Clearly, the hard activist would be a Carl Icahn or a Bill Ackman. Soft activism, is typically suggestivism, etc., or what mutual funds are doing in most cases. We are somewhere in the middle of that, but we focus on liquid versus illiquid because activism is a means to an end. The end being compound annual growth rate of your strategy over time, which you want to maximize for your clients. Another tool is universal definition, buy-sell discipline, all the due diligence you're doing. So the activism serves as a tool to improve our conviction, to put ourselves in a pole position to see what's likely to happen or not happen at the company. Of course, we don't know. We may suggest that they do X, Y, Z, but they're not going to tell us, nor do we want them to tell us. I want us to know about it when you know about it, when they announce publicly, what they're going to do, which is the way to go. So at that point, we stay always liquid. So don't be on the board, don't do the proxy battle, and be able to trade the position to do the dynamic sizing, which is such a big tool for alpha generation for us.
So you're selling because of price and
Valuation, yeah.
Are there other reasons you already sold the company that you didn't? Your activism,
Well,
maybe.
Yeah. What can happen is that obviously the fundamentals change while you're invested in a company, either in the end market or the way the company is deploying capital. So it's always a life situation. You're in public equity, you're in companies that are run by people in a real world, and so one needs to understand that things can change during this, say, 12 to 18 months, 24-month holding period. That's kind of typical for us. And so we might sell or scale back down if we see things develop in an adverse way from our original thesis, or if the management acts in a certain way in terms of a very overpriced acquisition or an ill-advised expansion in an area that we thought they should de-emphasize, that causes us to scale back or get out of the position.
Interesting. Your company is 31 years old.
Mm-hmm.
How has your style and process changed in these 31 years?
Not much. Style drift is a real killer of a niche or small investment business. We feel we're pretty good at one thing. Our clients come to us for a percentage, hopefully, of their assets to be allocated. If they determine that they want to be in equities, public equities, to a certain amount, we'll modestly put our hand up, like, please pick us for a piece of that. We're not going to be in tech. We're not going to be in large caps or growth or momentum stocks. We are in a different area. We think we will be a very value-added component of that will do well over time. Not every single market or quarter or year it will do well compared to the market, clearly, because we're not in some of these other areas. But over time, it's a long-term race measured over 5, 10, 20-year periods in which this should add value and be a very attractive way of compounding your capital and be a differentiator within a portfolio of other equity funds. So that is who we are and set out to be. The universe definition that I described to you, the pyramid we have in which we look for our targets, is the same as it was 31 years ago. Clearly, over time, as we grew, as we added experienced analysts and we learned more, we got better, I think, at the process, the repeatability of the process of due diligence. We got better at our constructive shareholder activism. It's become more productive, more profitable for us as we honed our message and our way of interacting with companies. But that's more learning curve and experience that we gained over time. And then, of course, the network that we have and the familiarity with all these companies around the world, that really is an asset that gives us a bit of a moat in this particular area.
Thank you very much.
Okay.
That's a good message.
Okay.